Good morning. It is Wednesday, July the 15th. Here's what's on the agenda. Oil gains for a third day as Trump threatens to ramp up attacks on Iran. But U-turns on Hormuz tolls again. Traders trim bets on rate hikes as US inflation eases, but Fed Chair Walsh says it is not mission accomplished on inflation. And AI demand powers another upgrade for chip equipment maker ASML after IBM said it's being left out of the AI party. Let's get to the markets then. A turnaround in terms of sentiment when it comes to the semiconductor story. You saw that overnight in the US with the Nasdaq 100 closing high by more than 1%. The Kospi then in focus for us today, gaining 7%. We know the volatility is there, of course. SK Hynix having a strong session in the US, and that's filtered through into the Asian session today. In terms of the futures story, after modest gains, very modest gains for European stocks at the close yesterday, you're looking to add so far 9 points, up about 0.2%. Some strong earnings stories in the US when it comes to banks, of course. The equity trading teams performing very strongly for the likes of Goldman Sachs and JPMorgan, and some earnings strength as well coming through for Europe with Richemont coming out with a beat and ASML as we mentioned. Brent crude though remains higher, and that is a continuing concern for investors, of course. $85 a barrel and remaining above that level right now, up 0.7% so far in the session. The countdown to the opening trade starts right now. So let's kick things off with tech then. ASML lifting its annual sales forecast for the second time this year, as a surge in artificial intelligence spending drives demand for the Dutch company's chip-making machines. Let's bring in Bloomberg senior strategist Neil Campling. Neil, we want to get to what's happening with SK Hynix as well, but let's start with the ASML story. The numbers breaking at 6 a.m. UK time, so a little over an hour ago, and it looks pretty strong. It looks like they are benefiting from this build-out in capacity, the build-out of foundries, and the demand coming through for their kit.
I think, Tom, the way you would frame it is that there were great expectations into the results, and crucially, in the guidance, they still beat those great expectations because they raised the guidance for the full year, expected, but they raised it above not just consensus, but all street estimates. So even the most bullish on Wall Street, they managed to beat those expectations. So that's a great print. And actually, for a step back quickly, if we look at kind of the AI winners baskets, if we look at the SOX index, the semis index benchmark, ASML has actually underperformed this year versus the chip peers in Europe and against the SOX index in the US. So that's perhaps time for a catch-up trade for Europe's biggest company. It is definitely a key enabler of AI globally, and this is encouraging. The key now will be the 2 p.m. London conference call, and analysts will be looking about longer-term insight into the guide and whether they had the capacity available to meet the demand that's being fueled, as you mentioned.
Yeah, it seems like they have plans to ramp up capacity because there had been some concern from some in the sector that maybe they would end up being a bottleneck. So we'll listen into that. One of their customers, one of their clients, amongst many, is SK Hynix. A very strong session in the US yesterday. I know you have real insight in terms of the linkages from a market's perspective in terms of how we should be thinking about whether this is healthy or unhealthy, how investors should be thinking about the dynamics now we see between the Nasdaq 100 and the Kospi with the SK Hynix and those two listings. What are the takeaways? If we step back from the last couple of days of trading when it comes to SK Hynix, what have we learned?
If you take the glass half full idea, then you look at Hynix and say the earnings are very supportive. It's very cheap in terms of the valuation. In that perspective, that's encouraging. It enables international investors to look for an alternative to, say, Micron in the memory space by investing in another pure play in terms of Hynix. If you want to take the glass half empty approach, then you would say that this has been, for the last 40 years, a very cyclical part of the chip market. And that the power of earnings looks great today. But if you look at it on a price book basis, it's very expensive relative to history, about 7 times versus the history. So there's that. Then you have dynamics around as a European listing on the Hynix. And the US list trades at about a 30% premium to the European list. So there's definitely dynamics going around in terms of the ETF positions, passive funds, the leveraged ETFs, etc., which have had a lot of headlines out in Asia in the last couple of sessions. So there is a sense in terms of volatility around the stock is unlikely to change anytime soon because of those other dynamics. But I'd like to look at what we see in terms of the longer term environment as to where investors look at the option around sort of the alternatives in the memory space and other chips on a longer term horizon, rather than looking at the minutiae of individual one-day moves, or even within a session sometimes there's high volatility.
Okay, helpful context. Neil, thank you very much indeed, breaking the numbers down for us in terms of ASML and the context around what we're seeing again with SK Hynix at the Kospi right now. And that major index, of course, in Korea up 7% right now. Bloomberg's Neil Campling. Meanwhile, on the macro front, traders have cut their bets. They've cut their bets on a July Fed rate hike after a softer than expected CPI print out of the US. They now see an under 20% chance of a move higher this month, down from almost 50% just yesterday, while a September hike remains in the balance. The repricing coming after Kevin Warsh delivered his first congressional testimony as chairman, warning against complacency on inflation.
It's one data point. The reason I created a task force on data is I don't want to overread or cherry pick data. There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Let's bring in Bloomberg senior editor Alistair Bull for some context around what we heard from the Fed chair and that inflation data out of the US. What did the data, if we put the data together, Alistair, and what we heard from Kevin Warsh in terms of his commentary, reluctant as he is to give that forward guidance, how does that inform our view about the outlook for rates?
Morning, Tom. So the cool CPI print definitely furnished Kevin Warsh with a soft landing for his first congressional testimony. I mean, those things can be real ordeals of fire. But he said, I think, what we expected him to say. It's only one print. We're going to need to see a series of numbers going in the right direction before we can draw any kind of firm conclusion about the next policy move. But he continued also to talk very sternly about the necessity to get inflation back to the Fed's 2% target. We know from the last meeting that there's a lot of concern that it's been above goal for about 5 years. And I mean, while he continues to talk tough, there's always, the thought in the market's mind that he's going to have to at some point back words with deeds. So it's really going to depend on the data. Now, if the data does continue to come in on the soft side, that could well take a rate hike off the table completely and start the conversation about a cut perhaps into next year. But we need to see how those numbers come out. And the longer Warsh waits, given this print now gives him time to wait, but the longer Warsh waits, the closer he gets to the midterm elections. Does he go in September? Does he go in October? If he thinks he does really need to take out some insurance against inflation. So I think that provided that the numbers don't really send a very clear signal, this idea of an insurance hike is going to kind of re-enter the conversation, Tom.
Okay, and it is the data that Kevin Warsh says we should be focused on rather than the communication. And so we've talked about the fact he doesn't want to do this forward guidance. He wants to change that dynamic for the Fed. He's got his task force as well, 5, I believe, of those task force. What did we learn, Alistair, about Warsh's plans to adjust and moderate Fed communications?
Not a lot, to be honest. I mean, he continues to say that he'll be transparent, that the task forces will provide regular updates, and he'll have some conclusions by the end of the year. But he didn't commit, and he specifically didn't commit to holding a press conference after every FOMC meeting, which has been the tradition for a number of years at the Fed. And he, I think he's going to continue to play his cards close to his chest. He doesn't want to forerun the outcome of the task forces. He said he's given them an open page, that they're in a discovery period, and so he's going to continue to sort of keep a little bit, sort of keep those views to himself until we learn more from the task forces.
OK, Bloomberg senior editor Alistair Bull on what we've been hearing from Kevin Warsh. He'll be speaking again, of course, today, giving further testimony. Alistair, thank you. Here's what else we should be thinking about throughout the day then. Today, US earnings, Morgan Stanley and United Airlines. We'll see if Morgan Stanley can match the haul, particularly when it comes to the equity trading business at Goldman Sachs. What a stellar day for US bank earnings yesterday. So Morgan Stanley is on the docket today. At 10 a.m. UK time, we're going to get the OECD Economic Survey of the UK. So a gauge there on the health of the UK economy with all its struggles and challenges ahead of a change in leadership, of course. And at 1:30 p.m. UK time, after that softer than expected CPI print out of the US, we get producer prices. So PPI dropping 1:30 p.m. UK time for the month of June. We'll see if that confirms the more benign picture for inflation out of the US. And at 3 p.m, talking of Kevin Warsh, the Fed chair, Kevin Warsh will continue his semi-annual monetary policy report to Congress, this time to the Senate Banking Committee. And at 7 p.m, the Fed will be releasing its beige book. So further details there in terms of how the Fed is thinking, what they're seeing on the ground in the US economy. Coming up, China's GDP, meanwhile, the growth unexpectedly slowing below the official target range. We're going to break down the numbers out of China. Plus, we will look at the stocks to watch at the open, including delivery hero Uber confirming it is in advanced talks to acquire the German food delivery company. Up next, we're going to be joined by Anika Gupta, Macroeconomic Research Director at Wisdom Tree. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg.
Do you anticipate that the strikes we're seeing this week against Iran will expand? Are you considering hitting energy targets or other locations inside of Iran?
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants. Next week comes the bridges.
US President Donald Trump speaking yesterday evening on Fox News. His comments following a fresh wave of strikes by American forces against Iran. Oil prices climbing for a third straight day this morning as President Trump climbed down after just one day on his call for vessels transiting through the Strait of Hormuz to pay the US a toll. Let's bring in Bloomberg's Abir Abu Omar in Dubai for the latest. Abir, how seriously should we take these threats from President Trump that he will look to infrastructure in Iran, that he'll look to energy, he'll look to bridges and roads? He's made these threats before, but is this time and this moment different?
Good morning, Tom. That's a really good question. What we've been seeing is that the United States has been attacking Iran over the past few days consecutively every single night. The latest round of strikes happened in the early hours of this morning, or was finalized in the early hours of this morning here in the Middle East. 7 hours of waves of attacks on some weapon launchers, some military targets. President Trump, as you just heard, saying that next week the U.S. will start hitting bridges, some infrastructure in Iran as well. So threats that, you're right, have been made before. I guess the real answer here is we'll have to wait and see. But when it comes to President Trump making claims and then backtracking on them, we saw a glimpse of that just yesterday. Within about 24 hours, President Trump made this very big claim that the U.S. will start imposing a 20% fee on ships making their way through the Strait of Hormuz. Those are cargo ships that are not Iranian, because when it comes to Iran specifically, the U.S. has reinstated a blockade on Iranian ports and ships. And then he backtracked quite quickly in the aftermath of that, saying that actually he's not going to do that after getting urging from Gulf nations here in the region, telling him to not do it and telling him that they will pledge investments, or should I say further investments in the United States. He said that he actually does not like that fee and he would much rather get investments from the Gulf into the United States. He was calling them massive investments in the United States. Now, Tom, our own sourcing suggests that at least one government in the region has not agreed to actually making those investments. But we see a return to this notion by markets that has been put through at the beginning of the year of the taco trade or President Trump going back on claims that he makes quite quickly. So for the time being, it's still wait and see. We still await to see whether more attacks are going to happen into the end of the week, into the weekend, and whether those attacks on key civilian infrastructure are going to happen in Iran next week. In the meantime, the Strait of Hormuz continues to see traffic at a near standstill. We're seeing a trickle of movement. We're seeing ships either go dark, turning off their transponders to be able to go through, but then a lot of ship owners are deciding to just hold still. But you mentioned oil prices earlier at around $85 on the barrel for Brent crude, a steadying motion from yesterday when we saw it arrive at $87 on the barrel. And this is again as we await and see if those technical negotiations come back to the table. We still have no clarity, by the way, on whether we're going to see a return to the technical talks mediated by the likes of Qatar and Pakistan. Countries in the region continue to be attacked. Kuwait this morning reporting that 4 naval personnel were injured as a result of those Iranian attacks that are happening as a retaliation of those U.S. strikes. Tom.
Okay, Bloomberg's Abir Abu Omar in Dubai with the latest out of the region. Abir, thank you. Let's bring in at this point Anika Gupta, Macroeconomic Research Director at Wisdom Tree. Anika, good morning. We have the here and now of higher oil prices, above $85 a barrel, 3 straight days of gains for oil. And then we have the backward-looking CPI inflation print out of the US and comments coming through from Kevin Walsh. Are the markets right to once again look through oil up at this point and the potential inflationary impacts of that, Anika?
Yeah, I think it's too early to say right now, Tom. I think the markets are overlooking a very important risk, and that is, yes, the July CPI numbers have delivered this decisive relief. But if we, pass through some of the details of the Walsh's testimony, it does tell us that, he made a very important statement stating that there, obviously this today's data has cleared and removed the possibility of a July rate hike. But looking ahead and given the turbulence, given the fact that we still aren't out of the woods when it comes to the US-Iran war, we could see that persistent elevated inflation having a very big impact for the probability of a September rate hike, which, is very much a live meeting at this point in time.
Okay, so you think September is possible? You think the Fed could go once this year? And if that is the case, Anika, how do you think the equity markets respond to that?
Yeah, so for now, as you mentioned, the equity markets are very narrow-sighted. They're just focused on the fact that we've got the July rate hike off the table, and in response, we've had this AI, we've had this rotation back into AI, back into growth-oriented names. But the reality is, if this war ends up being a little bit more protracted in nature, then more of the defensive segments of the market, such as value and more high dividend segments of the market, are likely to gain a bit more dominance within equities.
On the AI story, we have the strength coming through with it from ASML, so an upgrade there from that company, and we'll see to what extent investors welcome that news. But we have these dynamics that I wonder if they're causing you any concerns in terms of the linkages between the Nasdaq right now and the Kospi because of the role of SK Hynix. Are there some structural market tensions there? Does that dynamic, does the leverage story, the ETF story, and the greater interlinkages between those two markets cause any concern for you, Anika?
Absolutely. We are seeing the structural nature of these markets, especially with the leveraged ETFs having to take into account so much of churn when we are having these very strong moves within the Kospi index, have ramifications globally, because it does bring into play a more negative sentiment echoing from the Asian markets, and then that trickles down into global equity markets as well. And it is a bit concerning because the volatility has been very high, and that is clearly translating globally, we've seen this change in sentiment within the AI tech space.
Are investors overlooking dividend opportunities, high dividend stocks?
I think for now, yes, because when the global growth outlook tends to be of a moderate to medium term growth, then growth as a factor tends to trade as on a premium. And so what we have seen is this surge of inflows into growth and low duration equities. But the reality is, if we are entering a world of higher geopolitical risks, higher interest rates, and inflation being higher than it was a decade ago, then the factors that history has shown us, the factors that tend to be the best performing would be the dividend and the value-oriented sector.
And you're also making the case, as we think about Europe and we think about the continuing tensions between Ukraine and Russia, and in fact daily attacks by both sides, that European defence is still an opportunity because it's been rather unloved in recent months.
Absolutely. We have seen a change in sentiment towards defense as a whole, and European defense stocks have also taken a hit on the downside. But the reality is we're just coming out of a NATO summit, where we had seen some very important deals being signed. Nearly over $50 billion in new defense industry contracts were announced at NATO. We also received the Patriot production license that was granted to Ukraine to create long duration, demand pipeline covering production facilities, supply chain expansion. And we're seeing more integration within the European allies. That all tells us that, we are seeing a translation of these political commitments into being translated into actual order backlogs. And I think the story for 2026 is really to see that transformation from those rising order backlogs into execution on ground.
Anika, thank you very much indeed. We're starting to see that execution then when it comes to those orders for defence. There's making the case as well for high yield stocks, high dividend stocks, and the take there in terms of potential rate hike from the Fed in September. Anika Gupta, Macroeconomic Research Director at WisdomTree. Here's what else you need to know this morning. China's economy slowing more than expected last quarter, growing 4.3% from a year ago. That is the weakest growth in more than 3 years and below the country's official target range. The extent of the slowdown will likely dominate the agenda when the ruling Communist Party's decision-making Politburo meets later this month. Payment processing firms Stripe and Advent International have offered to buy PayPal in a deal valuing the company at more than $53 billion. That is according to a report from Reuters. The offer represents a 28% premium on PayPal's closing price on Tuesday. The report says the pair would jointly own PayPal with equal stakes and do not plan to break up the company. And Spain are into their first FIFA World Cup final since winning the tournament in 2010 after a comfortable 2-0 victory over France. A first-half penalty put Spain into the lead before Pedro Porro sealed the win just before the hour mark. It was a disappointing performance from favourites France, whose star attacking lineup managed just 3 shots on target. Spain will now meet either England or Argentina in Sunday's final. Let's check in on the European markets right now. European futures pointing to very modest gains of 0.1%. US futures in a slightly brighter spot. Nasdaq 100 futures pointing to gains of 0.8%. But that's a picture across European markets. FTSE 100 is actually called a little lower right now by 0.3%. Coming up, Fed Chair Kevin Warsh downplaying lower than forecast US inflation. We discuss fixed income with Andrew Bulls from PIMCO, the CIO. That is next. This is Bloomberg. We are 30 minutes from the start of the opening trade this Wednesday. Futures are looking largely particularly uninteresting at the headline level, just pointing higher by 1/10%. That's despite the fact you've had some solid earnings coming through in Europe out of Richemont and ASML. So we'll look at tech as a sector and see if it gets a lift from that second upgrade for the year from that maker of lithography machines over in the Netherlands. The banking earnings really strong in the US, of course, yesterday. Have Morgan Stanley on the docket later today. So we'll continue to watch the earnings impact. Again, European futures on the benchmark pointing up by 1/10%. Here in the UK, though, the FTSE 100 is looking to drop 40 points at around 10,490. CAC as well, down by about 4 points currently for the French futures, probably unlinked from the football result last night. US futures pointing higher on the Nasdaq 100 by 0.8%. Let's check in on sovereign debt bonds. A little bit more action yesterday. Today, a little bit more calm. You had the inflation data out of the US, the CPI print coming in a little bit more benign, a little softer than expected, at least on the month-on-month basis. The German 10-year is currently yielding 3.12, yields up just 1 basis point. So marginal selling coming through for the sovereign debt of Europe right now, but nothing too extreme. Treasuries are largely unchanged, and you're seeing BTP's yields up just 1 basis point over in Italy, just at 3.89. Of course, gilts opening at 8 a.m. UK time. We've been hearing from Federal Reserve Chair, of course, Kevin Warsh, downplaying the cooler than expected CPI data. Warsh spoke on the US inflation print at his first congressional hearing, where he said he remained committed to the Fed targets.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability. Productivity growth has been strong, predating gains from AI adoption. America's labor force appears stable. Job creation has, in fact, kept pace with the workforce. We want economic growth to be more broad-based. This committee had long committed to a 2% inflation target. That is our resolution. That's what I'm here to say and double down on.
So, committed to that 2% target, prepared to double down on that 2% target. Andrew Bulls, Global Fixed Income CIO at PIMCO, joins us for a view on these fixed income markets in light of what we've been hearing from the Fed Chair and other dynamics, of course, macroeconomic events, inflation, oil prices higher. Andrew, thank you for your time. Let's start on Kevin Warsh then. Do you and the team at PIMCO have a clear steer on which Warsh and which Kevin has turned up? Is this commitment to the 2% target suggesting that he is open to hikes at some point this year?
I think you have a very clear message on commitment to the inflation target. It's what we would have expected given Kevin Warsh's history, because, of course, he served as a governor at the Federal Reserve. And I thought that was the main takeaway yesterday. The latest inflation print was certainly a good one. You wouldn't expect him to overreact to one piece of data, but that was certainly favourable. I think that he is being pretty deliberate in not providing a lot of guidance. We know that. This means, some more uncertainty. We may have a little bit more volatility at the front end of curves. I think that's fine. But overall, I think, in the baseline, the Federal Reserve is probably on hold this year. But clearly, and you see this from the rest of the committee, not just from Warsh, if they feel they need to act, they will.
OK, you think they are on hold this year? Expectations for a July hike have been phased and faded by the markets. September is still very much live. You don't think they move this year, despite the strength that we're seeing in the US economy, and an assumption that maybe that inflation story reverses in July? So
I think our baseline would be they're probably on hold.
Yeah.
Policy rates compared with conventional measures of neutral, a little bit restrictive. So they, by not cutting rates this year, as the market had previously been expecting, you get a tightening overall in terms of the monetary policy stance. But I think it's pretty open, data dependent, and compared with the past, we'll get less forward guidance from Warsh. So wouldn't expect them to go in July, but I'm sure September will be in focus.
Does that move away from forward guidance make your job harder or easier?
I think it's just like the weather. There's no point complaining about it. Just adapt. And so, from my point of view, not providing a lot of forward guidance is perfectly sensible. Just look at events in the last week or two. Why be providing a lot of forward guidance in a very uncertain environment? Let the market react to the data rather than dots or commentary. So I think that is fine. You may have a little bit more volatility in the front end of the curve. I don't think that's a big problem. Now let's see if they'll stick to it over time. But from my point of view, being clear in terms of the reaction function, but letting markets react to the data is a very sensible thing to do.
Given the volatility you expect to see at the front end, do you want to steer away from the front end? Where are you seeing opportunities across the curve when it comes to US Treasuries?
I think when you look at US Treasuries, I mean, to keep it simple, there's an awful lot of uncertainty. There's Fed meetings, there's wars in Iran, there's data, et cetera, But when you step back, the level of yields looks pretty attractive. I think the 5 to 10 year part of the curve looks fine. And yield as an indication of return is a pretty good guide over time. So as a trade, there's lots to talk about in the short term. But just as an investment matter, the level of nominal yields, real yields, is very attractive. I'd say across the curve, and 5 to 10 year part of the curve looks pretty good.
Do you think if we get a step up in the conflict between Iran and the US, do you think we start to get a 10-year closing in on 5%? Is 5%?
We've been in a range, kind of 475 as the top of the range for the last couple of years. For now, that seems pretty reasonable to me. So we're at the higher end of that range. It's perfectly possible. Uncertainty in terms of the Iran outlook. The markets, in the first instance, focus on the inflationary impact, not least because we just went through 2022. But in the tail cases where this is a more significant shock, oil prices above the current levels over time, then markets should price the growth impacts, not just the inflationary impacts. So you could certainly move higher in terms of the yield. We've tended to think 475 as the top of the range has withstood the last couple of years. So for now, that seems pretty reasonable.
Okay. Switching focus to the UK, we're going to have a change of government come Monday of next week. Is the gilt market more sensitive to the energy shock or to political uncertainty? Where do things stand? What is priced in right now?
Well, I'd say that in terms of recent price action, the gilt market's more sensitive to the energy price shocks, and we've seen the moves in the last week. When you look at the shape of the curve, there's some risk premium for political risk, but not a great deal. If you look at the shape of 10s versus 30s in terms of the yield curve. From our point of view, we think the Bank of England in the baseline is not going to hike monetary policy, as we discussed with the Fed, by maintaining rates above neutral. Conventional estimates of neutral, they're maintaining a restrictive stance. And so I think there's risk premium to earn in the front end of the curve. In terms of the political risk, it's there. We're going to get more information in the next weeks.
Would you sell gilts if they appoint Ed Miliband as Chancellor?
No, I mean I think Ed Miliband. So I think Ed Miliband is less popular. You see the kind of the polls of the city. I think Ed Miliband is less popular with financial markets, maybe owing to the. His time as Energy Secretary. Against that, Ed Miliband knows the Treasury and economic policy making better than any of the other candidates. And so there's a number of things you would look for in a Chancellor. There would be economic policy competence, knowledge of the institution, the ability to lead the Treasury, and then the market perception. And two of those three, I would think he scores quite strongly. So let's see. Certainly briefing this week, it's not going to be him.
Okay. Away from the UK, you're making the case that investors should be exposed not just to DM fixed income, but emerging market fixed income as well. What is underscoring that view, underpinning that view?
Well, I think so. If you just start with global, it makes sense to have a global exposure, not just a single country exposure. So we just talked about idiosyncratic risk in the UK. We talked about the US. Across markets. There's always the domestic drivers. A diversified approach makes sense at the global level, and you can see over time your return per unit of volatility is better in global strategies compared with single country strategies. And the UK in recent years would be a great example of that. And then when you expand to high quality emerging markets, again, you get the benefits of global diversification, and you get the opportunity to earn attractive yields on the local currency side, on the hard currency side. You have a number of emerging markets where inflation, the picture is coming down. You have a number of emerging markets where levels of real yields are high. You've had basically fairly good economic management in a number of countries.
Is there a country that stands out to you right now as a screaming opportunity?
I think we have South Africa, we have Peru on the local rate side. I think the Middle East, Eastern Europe on the external debt side. FX, have a broad, diversified approach. We run currency strategies as well. I think it complements the G10 exposure. Again, the return per unit to vol over time looks attractive, but you want to have an active approach. You want to be very careful where you are investing across countries and do it based upon the fundamentals.
Okay, really interesting. Thank you for coming in and joining us on set, of course, with those insights across the global fixed income markets. Andrew Bull's Global Fixed Income CIO at PIMCO. Now, Wall Street's banking heavyweights kicked off earnings season by posting record quarterly profits amid an AI-fueled frenzy and, of course, geopolitical uncertainty. The industry had a particularly strong showing in equity trading. At Goldman Sachs, traders broke their own Wall Street stock trading records. CEO David Solomon pointed to artificial intelligence as a key driver of future growth.
The build-out of AI infrastructure remains in its early stages, and we believe this multi-year investment cycle will continue to drive elevated levels of strategic activity, financing, and capital formation across markets. The more expansive and complex this opportunity becomes, the more it plays to our firm's strength.
Okay, we're going to break down those numbers later in the show and look ahead to Morgan Stanley results today. This is Bloomberg.
Looking forward, we know that things rarely move in a straight line. While we continue to see a largely resilient economic backdrop in the U.S., risks can emerge quickly and drive periods of disruption and volatility across markets. A keen focus on risk management remains paramount as we support clients across a range of market conditions. But it's also clear that we are seeing broad-based momentum across the franchise and a very strong environment for client activity.
I can't tell you that it's impossible that we will exceed the 11%. We're just not going to box ourselves into that, given that we see opportunity to take actions on the offense, which are accretive to shareholders and support our path to our medium-term targets.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes. We benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better. But, how much better, I don't know.
The chiefs of some of the biggest US banks on record second quarter results from their stock trading divisions. We also heard from the CFO of Wells Fargo. Take a listen to what he had to say about the firm's growth plans and deal activity.
We're mostly focused, Katie, on organic growth. I think the opportunity we have across each one of the businesses is just, big, to grow organically. And that's what you've seen us really do now the last number of quarters. And I think, when you think about, opportunities for M&A, there could be some, product capabilities or other, payments related stuff that could be interesting. But it would be very much just adding capabilities to what we do. Our main focus is really growing sort of organically across each of the businesses.
Understood there with the focus on organic growth. But I do want to talk a little bit about the pipeline, because you did say when it comes to the M&A pipeline for Wells Fargo, it looks robust here. And I'd love to dig into that a little bit more. Are there any industries which particularly stand out to Wells Fargo at this moment, or that you're, pursuing more aggressively than others?
Well, across the investment banking space, we've been adding, people in equity and debt capital markets, our M&A practice, and all the coverage groups, just sector by sector over the last, few years. And the pipelines are quite healthy, now, and they've been that way for a while across really all the products set there, including M&A. And you're certainly seeing, across a number of different industries, sort of, deals that may not have been, totally possible, a couple of years ago. And so I think that idea of pursuing those strategic goals across really, in a pretty broad way is definitely alive. And the conversations the team's having, it really spans everything from healthcare to tech to media to, a whole different, all industrial sectors as well. And so I think you're seeing it in a pretty broad-based way. Now, we'll have to see what actually happens in terms of deals getting announced and done, but I think the activity level is quite high, and I think people see this as an opportunity to think broadly about their strategic goals, and M&A is definitely part of it.
Okay, Wells Fargo CFO Mike Santomassimo speaking to our team in the US. Let's turn now to today's markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore joining us on set this morning. Mark, let's start with the earnings story then. We've had earnings as well in Europe out of ASML and Richemont, but the bank story is telling us a lot. It tells us about geopolitics, it tells us about the capital markets and the opening there of things like IPOs and the underwriting, and it tells us just about the broader macroeconomic sentiment as well in the US. What stood out to you? Does this set us up for a solid earnings season? What stands out from these numbers?
So obviously very strong earnings, and we're expecting this to be a positive earnings session overall. I think up until quite recently, expectations were kind of going a little bit more subdued, and therefore they're easy to beat. But I think their earnings are now likely to be very strong. The AI capex bubble is continuing. We knew financials would always be strong, leading it. I think what's interesting is that 10 years ago, you would have said financials were kind of the leading edge of giving us the direction. But I don't think that's the case anymore. So are you saying, is this setting us up? I think we are going to have a strong earnings season, but I don't think it's because financials are providing the guiding light. I think it's all about AI still. And I think that this earnings season will be positive until or unless and hyperscaler says they're cutting their capex plans. And if that happens, that's a complete game changer, like just massive game changer. You do not fight that signal. But I don't think that's going to happen this earnings season. I think that we're probably still, a couple of quarters away. But however, every single hyperscaler earnings call, I will be listening very attentively. And if they ever say we're actually going to significantly scale back on our capex plans, that's the AI trade over.
Okay, and that's the timeline. And certainly ASML's numbers suggesting that we're not there yet. To your point, you're seeing not herd in the markets, herding in AI trades, but not just in equities. You're seeing also in FX and bonds as well.
Yeah, I don't know whether it's because I don't know why this seems to be more extreme than before, but it was really notable what happened in rates. So last Thursday, there was about 6 basis points priced in for July. By the time we got to the CPI meeting, it was about 50% priced. And that was an amazing move between Friday and Monday. And everyone I spoke to over the last couple of days in the hedge fund community was paid rates going into CPI. Warsh obviously regrets it a bit now. They know not everyone was doing July, but they're kind of paying at the front end. And what was interesting is basically all of them are saying, look, the price action says someone got the nod that Warsh was going to be hawkish or was looking to hike rates. And so everyone was kind of hopping on the same trade. But no one seemed to have the source information of why this was the case. But I think we're really seeing extreme herding in all markets at the moment.
Okay, extreme herding in all markets. Does the inflation story leave you more or less concerned about that dynamic? Or is it very backward-looking, given what we're seeing right now, today, in the Strait?
Yeah, I think exactly. I think what's the development over the Strait over the last week has kind of changed the game. I think we talked about this a bit yesterday, about how the tit for tat is now seen as adding a structural premium to oil prices. And so even though people have realised from the Strait of Hormuz it wasn't as terrible as we all worried about, and that there is a massive amount of fossil fuels in the world, I think that the supply of them is going to continue to be disrupted and be more expensive than hoped. We've also got what's happening in Russia-Ukraine as well. We're kind of focusing on the Strait, but the Russia-Ukraine thing is almost as problematic. So I think higher oil prices means, yesterday's CPI is too backward-looking and it's old news. It's not solved the inflation problem.
And we've got producer prices later today as well. We'll see if that adds further detail. Mark Cudmore, thank you very much indeed. Bloomberg Markets Live Executive Editor, of course. Let's get your stock Stocks to watch this Wednesday, bringing Chloe Melly, who is looking at ASML. Chloe.
Good morning, Tom. Indeed, ASML is going to be the big story of the day after the company upgraded its sales guidance for the second time this year, thanks, of course, to this AI boom, which is boosting demand for chip-making equipment. This could see this rally over the last few years get extended this morning for ASML. And not only that, but ASML has also said that Intel had started using one of its most advanced machines, and Intel has called this a milestone in saying that this shows that this machine can be integrated into this semiconductor manufacturing at scale. So that's also another win for ASML to keep in mind. Moving on to Swedish banks, and we've got two different stories this morning. We've got SEB actually beating net interest income expectations thanks to strong loan growth, while Handelsbanken missed net interest income expectations because of high funding costs. And of course, the reduction in borrowing costs in Sweden is affecting all of the Swedish banks, but it seems in different ways, and there's different levels of resilience there. So we'll be watching out for that as well. And finally, in luxury, Richemont has had a great latest quarter with the sales coming in way above expectations, and that is thanks in particular to wealthy Americans buying a lot of Cartier bracelets and rings. We've seen Richemont outperform the broader luxury index by quite a lot because the jewelry tends to be a bit more resilient to downturns than things like handbags and clothes, and so we could see this outperformance get even widened this morning on the back of these very strong results from Richemont.
Yeah, it also tells you something about the K-shaped economy in the US, doesn't it? With Pepsi warning about the consumer, but Richemont powering ahead with those US sales. Chloe Melly on the stocks to watch. Thank you. We are looking at European futures pointing higher by about 0.1%. The AEX over in Netherlands is the standout right now, pointing to gains of 0.5%. And of course, they can thank ASML for that. But again, across the benchmark, gains call higher by 0.1%. Here in the UK, FTSE 100, though, pointing lower by 45 points. The opening trade starts in the next couple of minutes. This is Bloomberg. A few minutes to go until the opening trade. Let's check in before we get the pricing today on what happened yesterday, what transpired on the S&P 500, which ended with a modest gain of 0.4%. The sentiment did return more positive yesterday. The yellow line indicating where the Stock 600 closed, and you saw gains of just 0.2% for European stocks by the end of the session yesterday. Then the S&P, of course, took over. The Nasdaq 100 had a decent session as well, gains of 1.1%. And what we saw in Europe was basic resources and energy at the top of the list across your sectors, with media and travel leading to the downside. But again, across the benchmark, gains of 0.2%. Today, futures looking to build on that, very modest. The inflation story is looking more benign out of the US. We've been hearing from Kevin Walsh, still sticking to that 2% target. The earnings story and that strength has come through with the likes of Richemont and ASML. We'll dig into the details shortly. Futures pointing up by 0.1%. Then FTSE 100, though, lagging, pointing low by 49 points. But it's the AEX in focus with those earnings from ASML, pointing higher by 0.5%. Talking of which, let's check in on the stocks to watch. ASML then, with the second upgrade for its full year sales coming through, and pointing to that demand picture for its lithography machines as its customers continue to build out to meet that demand picture. So capacity is being expanded at ASML, and it's a solid upgrade to the outlook for that company. So watch ASML and the AEX called higher. Richemont, stellar set of earnings from this jewelry company. Cartier sales very strong in the US. Sales numbers coming in almost double the estimates. And bank stocks after a very solid set of numbers from US banks. We're watching banks as well. Morgan Stanley's up on the docket later today. We're counting down now to the open, 3 seconds away, with European futures pointing higher by 0.2%. Worth noting, of course, oil is up for a third straight day. You've got Brent at $85 a barrel, up 1.2%. So the energy story, the inflation story remains, of course, in the background at the very least. President Trump suggesting that he could ramp up attacks on Iran, of course, next week. We had another set of strikes, 7 hours of strikes overnight last night. So there you have it. Stock 600 right now pointing low by 0.1%, but only the FTSE 100 currently giving us a print down 0.5%, in line with what the futures Reuters story was telling us. The CAC growing over in France, currently largely unchanged. We're waiting for that to reflect a clearer picture on the pricing. And it's the AEX, of course. We're counting down to that, given the strength from ASML. It's worth noting as well that GDP out of China, very weak. And that, of course, is going to have a read across, particularly to those European corporates that sell into the Chinese economy. Just a reminder of the continued weakness there. The CAC currently up 0.1%. The FTSE 100 is the laggard at the moment, down 0.5%. The IBEX in Spain down 0.7, despite the Spanish footballing victory, of course, yesterday, not reflecting in the equity markets. Across your sectors, it's consumer that is currently at the top of the list. And, of course, the luxury story and Richemont will be part of that story. Up 1.5%. Energy also gaining 0.2. Just two sectors in positive territory so far. Every other sector in negative territory. Media is under pressure again, down 0.7. Basic resources, which has shown a bit of strength yesterday, is down 0.6%. Tech is currently flat as a sector, but we'll see if that adjusts around the ASML story. ASML is halted, by the way, worth noting. ASML shares are halted after they raised their full year guidance. So the moment we get a pricing on ASML, we will, of course, bring that to you. Let's check in on the individual movers as well. This is the picture as we kind of go a little bit more granular. So on the luxury space, luxury, which has been under pressure as a result of the geopolitics and high oil prices, Hermes up 3.3%. You're seeing Hermes up 3.3%. You're seeing LVMH gaining as well. This is all thanks to very, very strong numbers coming through from Richemont. And it's really the US consumer at the high end that is playing its part. So an expectation that other parts of this luxury space will benefit from that spending strength stateside. Process in the tech space also up 2%. Novo Nordisk posting gains of 0.6%. On the downside, software, SAP weaker by 2%. Rio in the mining space softer by 1.6%. BASF in the chemical space currently down 1.5%. And Airbus and British American Tobacco also slightly weaker. Let's zoom out and bring in Madison Fuller right now, global investment strategist over at JPMorgan Private Bank. Madison, always great to get your insights on these markets. Maybe if we take a step back and think about the earnings that have come through so far, stateside and in Europe. And of course, we're only in the early stages of the earnings story. Mm-hmm. What are the signals are you getting? What are you zooming in on? Where do you think things stand so far? What stands out to you from the earnings story?
Sure. So I think what the market's really trying to discern is whether or not it's priced to perfection. And so I think that there's been an exceptional amount of earnings strength. And I think now, the forward-looking guidance will be as important as the prints themselves. So that's, I think, predominantly what we are focused on. But I think we would also push back on some of the, wider spread thoughts that concentration and broadness can't coexist when it comes to earnings strength. I don't think the two things are mutually exclusive. I do think that AI and tech, broadly speaking, is leading a lot of the strength, is doing more of the heavy lifting. Tech alone is supposed to grow earnings 60% year over year this quarter. But at the same time, we are seeing more sectors participate within that, with 10 of 11 S&P 500 sectors expected to produce profit growth this quarter.
OK, that's interesting in terms of the broadening when it comes to the earnings story. Worth noting that ASML is coming through huge gains in the context of a company, of course, that has this significant weighting, the most valuable stock, of course, in Europe. And it's jumping 7.7% right now. Almost 8% is the jump for ASML. You do not see moves of this size and scale for this company very often. So we'll get the historical context for that move. But that is a really significant jump higher for ASML on the back of this upgrade to its full year outlook. And so investors are certainly cheering that, which takes me to a question to you, Madison, about where we stand in this AI trade and the kind of numbers we're getting from companies like ASML, confirming that the demand story is there. How are you thinking about how traders, investors should be getting exposure more broadly to the AI story at this point?
Yeah, so I think that the market's really focused on not just excitement around the future potential of AI, but are we really starting to see the execution of that start to come through? So I think there's a really profound focus on return on investment, on, what does that CapEx story look like moving forward? Can that demand be sustained to fuel that spending? And then at the same time, what does that then flow through into corporate profit margins? And, how are they, facilitating all of that spending? And so I think all of those are dynamics that investors investors are watching, and it's not just a rising tide lifting all boats, which is certainly, I think, evident in the fragmentation that we've seen within the AI trade itself. And so I think that AI is not just a one sector story. It's very much one that we think that needs to be invested across the entirety of the AI value chain. And there we're really focused on assets that I think are, more capital intensive, harder to replace. So there's a degree of, I think, staying power and earnings durability to them. So that spans everything from semiconductors within the hardware space towards infrastructure and power. So you can think of even utilities, you can think of industrials. And so I think that, it's not just a one sector story when it comes to playing AI.
The valuations in those companies and providers of that infrastructure on energy, the utility story, the connectors, the fibers, everything that goes into data centers and supporting the infrastructure. How comfortable are you with valuations in that space? The door is still open for investors to get exposure. The valuations are not looking too stretched within that part of the AI story for you. Is that how you're thinking about this?
Yes, and I think for a few different reasons. Like, yes, you've certainly seen a lot of these names participate very strongly within, the AI, tech rally. But I think at the same time, and for many, you've actually seen valuations cool while earnings have actually grown stronger. So that rally has actually been more fundamentally driven rather than, valuation expansion driven. And then the last thing I would say is that when we think about valuations, it's not just on a 1 year forward earnings expectations basis, but what do earnings look like, 2, 3, 5 years down the line, and do we think that's, demand has staying power? And I think that we do believe that's the case.
Do you think executives, and maybe we'll put this question to them when we speak to them on the back of these earnings, do you think they'll come under more pressure to explain and give more colour and detail about the cost of tokens versus the ROI? How much patience do investors have, and do they need to be clearer on that link between the spend on AI solutions and the ROI that they are achieving or not achieving?
I think the further along we get in terms of the AI story and how that, continues to proliferate, not just through the market, but through the economy, I think transparency that investors will ask for in terms of, what does that return on investment look like is something that's going to persist, and I think is only going to continue to drive how investors, determine, where to place their bets when it comes to allocating to specific stocks, which I think is why, again, you can be looking at the Magnificent Seven, you can be looking at, a broader array of AI-related stocks, and you are not seeing uniform trading across the board within this theme. It's very fragmented.
I want to go back to your original point near the top of the segment where you talked about the broadening in terms of the earnings story. What assumptions then are you making about rates? What assumptions are you making about where the Fed goes as you think about that broadening story?
So I think what underlies a lot of the broadening and the strength in the fundamental story is also this, continued solid state that we're seeing from the U.S. economy, where you are, I think, seeing recovery within the jobs market. You're seeing yesterday, for instance, this inflation deceleration. Of course, I think there's going to be more volatility around inflation, and you probably settle at a higher floor than you have, in past cycles. But I do think our call has been for, I think, far more stability within future central bank policy expectations than perhaps with the market's pricing. I think it's gone from being really overly dovish at the start of the year to almost a rubber band snap towards being overly hawkish throughout the course of the geopolitical conflict. And we, I think, have stayed a little bit more in the middle, where we think the Fed is likely to remain on hold this year. But I think certainly as we watch the data, it's the probability is more weighted towards a potential hike. But even then, I wouldn't want to lose the plot when it comes to central banks. I think debating one hike, debating two hikes, it's very different than a sustained hiking cycle like we saw in 2022. So I think that's fundamentally different, and we shouldn't lose sight of that as investors.
Do you still want to be overweighted to the US versus Europe?
I think that we continue to see more of the growth and upside potential within U.S. markets over the course of the next year. Our total return expectations signify close to 10% upside for the S&P 500, more mid-single digits if you're to look at European large cap. But again, for us, it very much comes down to what are the underlying stories within each of these markets. And we absolutely do see opportunities within Europe. We can talk about banks alongside U.S. banks as well, but banks in Europe, I think, are a really interesting focus given the improvement we've seen from a fundamental perspective, but also the shareholder return that I think from a dividend perspective and also buyback perspective, which is, I think, important.
So that's interesting, because we've had someone else on the show this week also making the case for European banks, despite this weak kind of macroeconomic backdrop for Europe, particularly versus the US. But there is a case there to get further exposure to European banks. Some of those the positive catalysts, you would argue, are not yet priced in.
I think we continue to see more upside potential, especially when we're looking at, what that earnings staying power could be, and when we're also looking, I think, at some of the underlying drivers in terms of, loan growth, credit quality, and then I think, on top of that, of course, you are talking about a higher for longer rate environment, even if it is a hold or even if it is one hike and not a sustained cycle. Again, that higher for longer environment, I think, is a positive one for banks. And within the European story, I would also add, of course, this focus on security, and I'd also, highlight again technology within Europe as well.
What would you avoid right now? Which sectors, whether it's Europe or the US, is there a sector that stands out to you that's either looking too richly priced or fundamentals are looking fragile? Is there anything that you would steer clear of?
I think that, again, it comes down to the individual, company stories, but there are areas of the market that we see, less promising opportunity. For instance, staples is one of those when we're in more of a, a volatile inflation environment, and, the read through into what that means for raw materials and what that might mean for consumer staples and durable goods. That's probably one area that we would highlight as being a little bit more, hesitant on.
How are you thinking about the UK right now, UK stocks? I mean, there's the FTSE 100 or the more domestic stocks. Is there a role to play? Is there once we get more political certainty after Monday, do you relook at allocations around the UK, or is the growth story just not conducive to wanting to have exposure?
So I think the market's not the economy for any of the markets that we're discussing, as you know, and so certainly you might see the UK market trade in a way that might feel counterintuitive to what the economy is also signifying. But I think given the degree of uncertainty that we continue to face, we would take a very, I think, selective approach to investing within the UK market.
Okay, very interesting. Madison, thank you as ever for your time, for your insights. Madison Fuller, Global Investment Strategist at JPMorgan Private Bank. Let's check in on the Core 6 right now, and ASML is going to be the standout as we bring up the chart for you. There you go, the pop of 5.5%. You had seen gains of 7%, which had been, I believe, the strongest gain off an earnings picture for ASML since January of 2024. The gain's now 5.4%. So still decent for ASML. On the downside, you're seeing pressure on Rheinmetall, speaking of the defence space, down 3% right now. Rheinmetall taking a knock then. Nestle also a bit weaker by 1.2%. Schneider Electric just down by 0.3%. LVMH in the luxury space, that is the other upside story coming through on the back of decent numbers, very strong numbers for Richemont. So LVMH is up 10 points, up 2%. Let's get more in terms of some of the individual stocks on the move this Wednesday, and bringing Chloe Melee. Chloe.
Good morning, Tom. Indeed, you were just talking about luxury, and we are seeing green across the screen for that sector this morning after Richemont came out with very strong sales numbers that were driven in particular by strong demand in the US for Cartier jewelry. And so this is the first big luxury company to report this season. And as we can see, this is injecting some optimism into that sector and driving up the rest of that industry this morning, with LVMH, Hermes and Kering also in the green. We are seeing a very similar story for ASML, which is also driving up the rest of that sector, with the exception of ST Micro. So ASML came out with an upgrade on sales guidance, and essentially the fact that this AI boom is really boosting demand for chip making equipment. And so we are seeing that read across in ASMNB Semiconductor this morning. Moving on to the banking sector, and specifically in Sweden, well, we have two different stories there. We have SEB beating in net interest income and therefore seeing that boost in the shares, and Handelsbanken missing net interest income estimates and therefore seeing that bit of a drop in the shares. It seems that those two companies, those two banks, have reacted very differently to this change in the interest rate environment in Sweden and have different levels of resilience to that. Moving on to the house building sector over here in the UK, and Barratt Redrow is up quite strongly this morning, more than 4% after announcing a buyback and saying as well that profit will come in line with expectations. This was seen as quite reassuring given the very worrying updates that we've heard from different house builders over the last few weeks. It's worth noting that those rising building costs and that lower demand are still challenges for that sector. And finally, let's end on Evotec, which is the pharmaceutical company that yesterday saw a huge drop in the shares after cutting its full-year sales guidance. And today it got downgraded by TD Cowen analysts. And so we're seeing further weakness in those shares this morning, down more than 6% for the pharmaceutical company.
Chloe Melly, thank you very much indeed with some of the stocks on the move this Wednesday. Coming up, more on ASML as the firm boosts its full-year outlook, riding the global AI investment wave. We have the details and a view on what could be next for this company. That's coming up. This is Bloomberg. Welcome back to the opening trade. We are 18, almost 19 minutes into today's session. Across the European benchmark, you are seeing now modest losses of 0.1%. Here in the UK, the FTSE 100 is down 60 points, as you can see. The CAC current is over in France, currently down 0.2%. The DAX also weaker by almost a full 1 percentage point. This is despite the fact that we have strength coming through for earnings from ASML and in the luxury space as well. And luxury as a sector is one of the best performers, is the top performer right now, up 2%. Tech is also gaining 1.6%. Shares of ASML higher. That is the positive story in the tech space, and higher by 6%. Look at that, after the firm lifted its annual sales forecast for the second time this year and laid out plans to increase production as the surge in AI spending drives demand for the Dutch company's chip-making machines. Let's bring in Bloomberg's Amsterdam Bureau Chief, Dasha Afanasieva, now for the details. Dasha, talk us through the earnings then. Where is that demand coming from for ASML?
So for the quarter, ASML beat on both sales and net income, but what we really care about is the forward-looking indicators. And for the full year, you got quite a significant increase in the outlook, as you said, for the second time. Of course, that's driven by AI capex spending. ASML's customers are scrambling to get more capacity, and then therefore, at least for logic and DRAM, their own customers are putting in longer-term agreements. So that's why ASML is given this much more detailed update with greater visibility for 27 and 28.
That's really interesting. Those long-term agreements are starting to benefit ASML, so we get a bit more clarity. What have executives been saying about how the company can ensure that it delivers on this high demand then?
Well, that's right. Sort of the demand has been less of a concern recently, and it's been the question of whether ASML can actually meet that with supply. And I think ASML sought to reassure markets on that today. It's increasing capacity by 30% next year for EUV and investigating whether to do so in 2028 for EUV. And of course, EUV, which is the second most advanced machine that ASML has, drives demand in DUV because each chip is made with both. So they're looking to increase capacity for that by 30% in both years too.
What are the order plans then for, as you talk about EUVs, what do we know about their order plans for their EUVs, whether it's the low or the high NA? Do we have more details on that?
Yeah, we do. So for the EUV, what's underpinning those capacity expansions is that they're already close to receiving all of the EUV orders they need for 2027, and they're increasing they're also getting a large number of orders for 2028 as well. On the high NA, there's a major milestone for ASML in that Intel, one of its biggest clients, has said that it's actually properly using the most advanced high-NA machines, which means that the new Intel chips will actually be using this machine, which is important because there's been question marks over the adoption of this most expensive machine, with TSMC, for example, saying it costs too much for now.
Yeah, no, that's interesting. What we've been hearing from Intel, because they took I believe the first high NA EUV, but were kind of using it to test, and now they're actually using it for production. So that's an important marker, isn't it, as you say, for ASML. Dasha, thank you very much indeed for that update on of course, a company that is currently Europe's most valuable, with the stock up close to 6%. Dasha Afanasieva with the details there. Let's turn to the luxury space, because Swiss luxury retailer Richemont, their shares are jumping as well, and lifting the broader luxury sector after its first quarter sales expand nearly nearly twice as strongly as expected, supported by robust demand among wealthy Americans. Richemont's jewellery division, which accounts for 3/4 of its business, posted growth of 24% in a sign of resilience against a broader luxury sector slowdown. Is that still what we're seeing? Let's bring in Bloomberg opinion columnist Andrea Felsted. Andrea, what is driving this US demand? The US story is really strong.
It is, and it tends to be correlated with wealth creation and stock market. And as we know, the stock market has been on a tear. When Americans see their stock portfolio go up, they treat themselves to luxury goods, and that's what's happening.
Okay, so it's partly linked to the stock story, the equity story.
Absolutely,
okay,
yes.
That's really interesting. We wrote there in the intro then that this is on the backdrop of a slower picture when it comes to the luxury story. Is that the right way to frame it at this point?
Well, this is undoubtedly good news. US spending is still going strong. There were worries it would slow. China does seem to be recovering, albeit slowly. China is going in the, so you've got those two engines of growth are going in the right direction. But we shouldn't get too excited. There is limited read across. Jewellery has been a very strong sector. As the price of handbags has gone up, jewellery's looked better value for money. So many customers have switched to jewellery. Richemont has some fantastic brands, namely Cartier. And although it's jewellery that's driving it, Cartier watches is counted in jewellery. So the strong growth in Cartier watches, the Panthère has been a real standout, the Bangle watches, the switch from those big chunky steel sports watches to smaller gold watches. Richemont is at the forefront of that.
So the point you're making is that the gains that we're seeing in the luxury space today, the read across from Richemont maybe isn't justified. This is to some extent an idiosyncratic Richemont story. At least Richemont has a particular story to tell.
Absolutely. I mean, it's no doubt good news. This shows luxury isn't falling off a cliff, but it's perhaps no one else will perhaps be as good as Richemont.
Okay. What else? What other trends are you going to be watching for in the earnings story when these companies report? Is it China? Is it that K-shaped economy in the US? Is it production costs? Is it input costs? Is it metal costs? What else is going to be?
I think one of the other things to watch is we've had this great luxury reset, lots of designers. So we're going to get all their collections sort of came in, probably from the start of this year, the new designers' collections will be coming in. We need to see if they're working. So this is going to be the first sign of whether that great reset is encouraging customers to buy.
How is things like AI changing luxury in terms of how consumers access these products, the marketing for some of these, how designers are thinking about using AI tools? Is that something you hear about? Are these companies starting to think about that?
Yes, I mean AI is starting to change the way we perhaps search for goods. The search is different, so you maybe get different kind of search results. I don't think we're going to buy luxury through a bot. We might buy something, functional, but I think luxury, you still want that personal touch and you want that, you want that feeling when you buy luxury.
Before you drop thousands of dollars.
Exactly, yeah.
Okay, Bloomberg opinion columnist Andrea Felsted, thank you very much indeed on those Richemont earnings and the read across for the broader luxury sector. Coming up, we're going to move from luxury to what is happening in tech. IBM, very different story when it comes to AI. The wipeout in IBM's shares yesterday after disappointing earnings was quite remarkable. Reigniting concerns about the software disruption, of course. IBM has lent into software in recent years. We're going to discuss those concerns for the sector with Andrea Urbach from Cambridge Associates. That view and that context is coming up next. This is Bloomberg. This is the opening trade. We're 30 minutes into the Wednesday session. This is the picture. Europe not really benefiting so far across the benchmarks from the gains that we're seeing in terms of the likes of ASML, the luxury space from Richemont as well, with some really solid numbers coming through for both companies. Across the benchmark then, you're down 0.3% after modest gains of 0.2 yesterday. DAX now down more than 1% over in Germany. You're also seeing losses here in the UK. The FTSE 100 back below 10,500, dropping 82 points, down 0.8%. Let's talk about tech away from ASML. ASML showing the strength, the picture around demand. IBM yesterday, wow, what a shocker. The stock's suffering its biggest single-day drop since at least 1968. Even Neil Campling wasn't around in 1968. After its prelim, second quarter revenue fell short of Wall Street's expectations. The CEO, Arvind, I'll give some context to that, Arvind Krishna, said IBM was caught off guard as customers shifted spending towards servers, storage and memory. Let's bring in senior strategist, not that senior, Neil Campling. Neil, explain for us what is going on and going wrong for IBM then.
A bit of context is that where the stock is now trading is only back to where it was in May of this year, before we heard about the US government investing in the company, in the space, in the area it's involved in. Now, I think the big concern from left field in yesterday's update was the fact that they were effectively saying that it's not just like sort of capital being deployed across everything. It's that to invest in the AI infrastructure side, clients were putting other projects and other investments on hold. So the concern is then, is this an IBM thing or is this an industry situation? And that, for the time being, is an unknown. We're going to hear from other mega cap tech stocks like Microsoft later this month, who will give their first sort of full guidance for their following fiscal year to see, again, whether there is software issues or whether it's just AI investment is coming at the expense of other spending. So I think it's the unexpected nature, and also if you look at the actual letter that was written by the CEO yesterday, there were concerns because we've been talking about sort of software being disrupted. Does it then impact big IT service companies in terms of future bookings guidance from companies like Accenture, for example? Is this more signs of AI victims, as in companies that are losing out to the capital being deployed in a very sort of unique set of properties? So it leaves more questions in some respects.
It was quite the mea culpa, wasn't it, from the CEO in terms of how the team had missed the ball. It is a reminder, the wrinkles and maybe distortions that are coming about as a result of this, of the money piling into different parts of the AI space, and then what is then left exposed. IBM have lent into software. How much has that been a challenge for them? Does it bring this? A number of software names were underwater yesterday, or at least under pressure and selling off yesterday. Does it bring that SaaS apocalypse fear back to the forefront?
It will bring that fear back, although, for some context, if you look at the start of this quarter, the start of this month, there's been a massive shift, actually, into software, hugely outperformed. There's a couple of baskets. Software had outperformed chips by more than 20% in the first sort of 10 sessions that we'd had this month. So there's a little bit of a reset there. And if you looked at what happened at the start of the US session yesterday, the software ETFs were down significantly, chips were significantly higher, and that did actually trail off in terms of that disconnect during the session. So it will certainly bring that back to the fear for sure in terms of the SaaS apocalypse, and whether the whole idea that companies like Anthropic, in terms of the key frontier technologies, are able to do what software hasn't been able to do or taken many years or decades even to perform certain functions. Anthropic has managed to do in mere hours. So those kind of questions will definitely remain.
Now, Neil, in the break, you mentioned to me that you're watching credit, and particularly credit linked to hyperscalers, and a Goldman Sachs index at that. What are you watching on that front?
Yeah, so we're doing some analysis at the moment. There are this particular basket that Goldman's have created is looking at these perceived very high quality AI tech stocks. But in terms of the spreads themselves, they're really kind of giving a sign that the cost of this debt is really blowing out. And it's something that I think you've mentioned on this program a number of times in the past, in Oracle in particular, which doesn't have the balance sheet or the free cash flow that some of the other big tech stocks do have. But now this basket is kind of suggesting that there's some potential stress underneath the hood, perhaps, that's moving in other parts of the market. So we're going to do some more work on this. But it's something that, I'm a markets-focused, equity-focused, so on. But I'm also well aware that in terms of the bond markets are kind of really like the big brother to equities in terms of they'll determine the long-term outcomes for these kind of situations. So we need to keep an eye on this for sure.
Neil, Thank you very much indeed, Neil Campling, of course, with a view there on what is happening across IBM and the credit story as well when it comes to these big names and some of the hyperscalers and the spend around AI. Let's get more analysis now and bring in Andrea Albach, who is Global Head of Private Investments and Partner at Cambridge Associates. Andrea, thanks for coming to the studio from SF, from San Francisco. Yeah. What is your take in what's happening with software and the SaaS apocalypse? Do you have much exposure to these names? Where do things stand?
Well, when you think about it from a private markets perspective, so in the private markets, we're investing in companies that haven't yet gone public, right, or may not have issued debt in a public context. And so within the private markets context, about 37% of all capital is deployed into enterprise software. And Tom, I'm not talking about venture capital, which is below the private equity side. It's within the control investing in the private markets. So enterprise software and investor exposure to enterprise software is very real. And the SaaS apocalypse definitely reverberated around the private markets today.
But was the baby thrown out with the bathwater to some extent?
I would argue yes. If you look at the average, the median enterprise software multiple is now around 3.7 times revenue. I do not believe that every private enterprise software company is worth 3.7 times revenue, nor do I believe that every AI company is worth, I think the median is 25 times revenue, right? So there's
that gap is going to, those two things come together. The multiples for some of those AI companies come down.
Yeah.
Do you, when we get an Anthropic listing or an OpenAI listing, how does that change the dynamic for your space?
Well, what's really interesting about that is if you dial it back, I think 50% of all IPOs are venture backed or private equity backed. So a lot of the exits that we're all experiencing right now, we're expecting, are actually coming up and out of the private markets. And as you know, the average age of a company going public today is what, 12 years? So we have a chance to watch these winners really begin to emerge and gain quite a bit of momentum before they hit those public markets. I think the impact of what we're watching with SpaceX, for example, right now, is it's really lifting all boats in the venture space. So pre-money venture valuations across all stages are up significantly. Even the seed rounds are up 20% in value over last year's pre-money valuations alone, and even more significantly in the later stages, which is really the kinds of companies we're talking about right now.
As the IPO pipeline opens up, does that sideline the secondary story? Because that had been quite a driver of returning liquidity to investors and to employees, particularly last year.
Yeah. The reality is there are thousands and thousands of venture-backed companies, and some are doing very well, as we talked about. Not every company should be valued at the median amount, and there's always a certain number that are going to go public. But if the average number of IPOs is about 100, maybe 150 in a good year, and there are thousands of venture-backed, there's still going to be a healthy market for secondary. But I do think that the post-IPO market performance of these venture-backed companies is going to lift and increase market valuations across the board and probably benefit the secondary trade market as well.
We've been talking again this morning about the fact that, and maybe this comes up on earnings calls and when we interview and speak to the CEOs of publicly listed companies, about whether they give more transparency, more detail about the token spend and the ROI. And there's a timeline. There seems to be, investors have been relatively patient on this story, but whether that timeline starts to compress, how close we are to the point where investors say, do you know what, we need more evidence, so that token spend that's increasing and the ROI maybe isn't matching that. How are you thinking about that story? When for you do we get to a crunch point on needing to demonstrate real ROI?
Well, Tom, what I would say from a private markets perspective, the investors, Cambridge Associates, we're talking with the managers that own these private companies all the time. And so we're exactly monitoring that, right? The farther we get away from the blast radius of February SaaS apocalypse, the more we get into, all right, how much are you spending? What's really happening with your incorporation and integration of AI into your tech stack, into your product development? Are we watching customer retention wane or increase? Are we watching your cost and your profitability margins increase or stay the same? And so we are starting to see a little bit of noise around, okay, we've had enough fun in this sandbox of experimenting with AI. Now it's time to put it to work. And in the private market, we are absolutely talking with the owners of these companies and in many cases the management of the companies to get a real feel for is the rubber starting to meet the road today?
Are you seeing evidence of that?
It's interesting. When we back up and look at the Bessemer M Cloud Index for enterprise software, you can see that median revenue growth has been increasing slightly over the last couple of quarters. So I'm viewing it as, okay, retention is holding. Are your profit margins increasing, staying the same? Talk to us about how many initiatives you have on the go at your company. It's going to take quarters. It's going to take time, right, for all of that, all the evidence to show up in the financials. And then I think the markets will adjust and start to move forward with that information.
What brings you to London? What are you seeing? Are you seeing opportunities in the UK, seeing opportunities in Europe?
Absolutely. What we've noticed in Cambridge, we're a global firm where we have investors that we're working with on a global scale, and more capital is interested in coming to Europe. And so we're watching a little shift in the weights in the private market towards adding more European exposure.
Is that because Europe is cheap or because Europe has innovation?
I would say Europe is never cheap.
Really? Okay.
Actually, the performance of the European private markets usually is right on par with the performance of the U.S. market, which is broader and deeper. But I think what investors are seeing here is more opportunity to get in maybe on ground floor development of the private market, investing in certain industries that are taking on more private capital. Keep in mind, there's something like, I think, 45,000 private companies in the UK alone. And so there's a lot of opportunity here from a private markets investor perspective.
Okay.
And that's just the UK.
Yes.
Like, the rest of Europe, just add to that.
We've seen a lot of US capital coming and increasingly taking public companies here private as well.
Yes.
In the UK. And part of that seems to be a valuation story, that there seems to be a mismatch in terms of how public markets value companies versus private markets, at least in the UK.
I mean, typically, if you're going to do a public to private, you're probably paying a premium to the current share price. But I also think part of the calculus that's happening in the private markets is these managers are taking control of these companies and maybe bringing their legions of value creation talent, operating talent. We have an AI lab that we're going to bring to this company as well. And so really working with that company privately before potentially re-debuting it publicly or selling it on. So there's a lot of work behind the scenes to understand why are we going to take this company private. And from a private markets perspective, that often does play out very profitably from an investor perspective.
Okay, really interesting. Andrea, thanks so much for coming into the studio. Come back next time you're in London. Really appreciate your insights. Andrea Arbach, who is Global Head of Private Investments and Partner at Cambridge Associates. Coming up, talking to the UK Chancellor Rachel Reeves delivers a cautious economic outlook in what is likely to be her final Mansion House speech. That is all but certain. This is Bloomberg. Welcome back. We are 46 minutes into the open here in the UK this Wednesday, and you're looking at negativity across the benchmark, down 0.2%. It seems that the oil price story, the tensions in the Middle East, Brent above $85 a barrel, oil up for 3 straight days, is a bigger risk factor for the equity markets of Europe, as we've seen, of course. And this is the headwind, it seems, looking past the strength that's coming through on the earnings front from the banks in the US, from the likes of ASML and Richemont. It is the geopolitics, it's high oil prices that continues to drag and be a concern for European equities. The UK as well, FTSE 100 is currently down 0.6%. Talking of the UK, the Chancellor, Rachel Reeves, delivered what is likely to be her last Mansion House address yesterday, where she cautioned about the UK's economic protection.
The resumption of hostilities in the Middle East in the last few days has shown that our economic resilience will continue to be tested. And the market response to those changes shows that there is still work to do to ensure that our economy and our country is protected against a volatile global economic landscape.
Bank of England Governor Andrew Bailey also spoke at the dinner, where he called on the incoming government to prioritise economic growth and maintain fiscal discipline. Let's get more with Matt Bunny, UK economist at Bloomberg Economics. Matt, what did you make of what we heard from Andrew Bailey, clearly signalling and giving a message to the incoming new government of likely, of course, Andy Burnham?
So the purpose of Burnham's speech was really centred around regulation and how that can boost growth. There was a nod towards the need to drive up potential growth, as you mentioned, perhaps a nod to the incoming Burnham government. I wouldn't say there was anything materially new in there for investors or on the direction of monetary policy. What is going to be more important for monetary policy, of course, is the developments we've seen recently in the US and Iran and the increase in energy prices. Indeed, we've seen markets up their bets for rate hikes from the Bank of England to a bit over 1.5 by the end of this year. That said, it's worth noting at this stage, it doesn't look like the inflation issue is evolving into a more persistent problem. Of course, that remains a risk, but at this stage, inflation expectations remain in check. We're expecting the labour market to soften over the back half of the year. So that is why, at this point, we still expect rates to remain on hold over the remainder of the year, unlike markets.
OK, that's interesting. So it's a softening of the labour market, presumably weaker wages then, and that maybe is going to be a bigger factor than the inflation story. But as you say, the caveats around what's happening, of course, in the Middle East. PIMCO's Andrew Ball's telling us he doesn't think the BOE hikes this year, which is interesting. What are we hearing? What more do we know about who is going to be in Burnham's team, particularly when it comes to the Chancellor?
It's the question everyone wants to know the answer to. The pick for Chancellor will be an important signal of the direction that fiscal policy is heading in. A name that's been floated is Ed Miliband. If Ed Miliband is the pick, that would signal a more material shift to the left for fiscal policy. Other names that are being floated are the likes of Wes Streeting, which would be more consistent with the continuation of the kind of Starmer-Reeves economic model. But looking more broadly, we're still trying to kind of get a sense of what exactly Burnham's policy platform will look like. He oversaw a period of remarkable economic growth in Manchester as mayor. He has spoken about the importance of devolution, moving power outside of Westminster to the regions, about putting more, getting more public control of essential services, as well as increasing house building. Whether or not he can deliver on these promises obviously remains to be seen.
Have we heard anything from Burnham and the people around him that suggests that they're going to do anything in the short term? Those sound like long-term changes and significant changes, but are they looking to do anything in the near to medium term that can significantly shift the growth dynamics of this economy?
This is a really good question, because the longer term issues that you point to don't often have short-term political payoff. And Burnham is obviously going to be acutely aware of a general election coming up in 2029. So we think it's quite possible he will look to implement some kind of cost of living relief in the next budget, effectively to bring down inflation, to help win over consumers. The question will be how they fund that. He's ruled out any of the big tax levers that the government has, because he said he's going to stick to Labour's manifesto commitment. So one potential avenue they could pursue is raising capital gains tax. OK. Matt, thank you very much indeed. Matthew Bunny from Bloomberg Economics. And what we've been hearing at Mansion House and the potential policy coming through from the likely incoming Burnham government, of course. Let's look ahead at what else we are watching throughout the day today. US earnings, of course. Morgan Stanley up front on the banking space after the significant gains that have come through for the US banking story and the banking earnings strength yesterday. So we'll see if Morgan Stanley can build on that. United Airlines in the airline space as well, coming through with numbers. At 10 a.m. UK time, the OECD Economic Survey of the UK will come out at 1:30 p.m. after softer than expected consumer price in the US, CPI index in the US. We're going to get producer prices. That's for the month of June, so that will build on that picture. That's 1:30 p.m. UK time. At 3 p.m, Fed Chair Kevin Walsh is back, giving testimony, his semi-annual monetary policy report to Congress, this time in front of the Senate Banking Committee. So we'll be across that for you, of course. He says he remains committed to the 2% target of the Fed. And at 7 p.m, we're going to get the Fed releasing its beige book as well. So the Fed taking up some of our attention today as well as yesterday. Speaking of banks, Wall Street's biggest lenders shattered equities trading records in the second quarter. JPMorgan Chase executive CEO Jamie Dimon, of course, credited a surge in market activity for his bank's record profit, while cautioning it may not last.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better, I don't know.
For more, let's bring in Bloomberg's Tom Metcalf, who leads our European finance coverage. Tom, I mean, record after record seems to have been broken, particularly when it comes to equity trading yesterday from the big US banks. What stood out to you? How have they managed to achieve this? And how does this set us up in terms of the broader banking space?
Yeah, so the numbers we're seeing were enormous, like really across the board on the capital markets side, but particularly, first of all, JPMorgan came out and, breached 6 billion on a quarter, first time that's happened, and then Goldman came through with 7. So it was...
Goldman's like, hold my beer.
Yeah, exactly. It was quite the day. I mean, look, there's a few things there. One is, and I think Dimon spoke to this, like maybe this is as good as it gets in terms of, a lot of things coming together. And there was an interesting column, actually, from my colleague Paul Davies saying, part of the reason these numbers are so large is what we're seeing in the markets, right? There's this huge AI trade, there's lots of speculation, perhaps there's lots of leverage behind some of these, shares trading on the retail side, for example, or something like that. So it's really interesting. I mean, it's, one of those quarters, as I say, you really can't imagine how it went much better for whether it's the deal makers or the traders. But those comments from Dimon are interesting in that there is sort of still that note of caution and, frankly, I think, it's hard to see how they can keep this run going, but I've been saying that for a few quarters now, and every time, whatever's happening in the wider economy or the wider geopolitical sort of space, the US banks just keep on delivering.
They keep on delivering. What about costs? Is that a cost looking comfortable? Is it anything on cost that causes concern?
Yeah, no, definitely. And actually, initially, JPMorgan, at least in the pre-trade, its shares dipped despite these kind of blockbuster numbers, precisely because of that question around, are there sort of costs going to be higher than expected? The bank was kind of guiding they're going to be, a couple of billion higher. So certainly that's something investors are looking at, and you can also see that come through in the Citi sort of share reaction, where again they blew past estimates, but actually it was the CEO's comments around, we might be investing more in the coming months. It's sort of spooked investors in terms of, how big are those costs going to be? And I guess it shows how fragile, it's very much sentiment driven, I suppose, because everything is, as people have been saying for months, if not years now, everything seems to be priced for perfection.
Do we assume, given the strength that came through for Goldman Sachs from their trading team, that Morgan Stanley will have had a similar quarter? What are you watching for when they come through with their earnings later?
Well, I think it's one of those where, the bar was already pretty high, and now after yesterday's results, Morgan Stanley similarly have to kind of deliver. I mean, that's the thing. What I was interested after JPMorgan came through was like, okay, have they maybe taken a bit of share from other banks? It doesn't seem to be. It just seems to be the pie is getting bigger. So I would expect Morgan Stanley to sort of also deliver, but the question is whether they can quite do what a Goldman did, which I think was something like 135% jump.
Okay, just 135%.
Just 135%.
Jump. There's the bar. There's the bar for you, Morgan Stanley. Tom, thank you very much indeed, with a roundup, of course, of what we saw from the US Bank's earnings story yesterday, and a preview of Morgan Stanley later today, of course, which we'll be covering for you. Tom Metcalf from and leading our finance team here in EMEA. Let's switch focus right now briefly. Just 3 teams remaining in the World Cup. England taking on Argentina tonight. Starts at 8 p.m. London time. I won't pretend I don't have a bias. Come on, Jude. Come on, Kane. That is coming up, 8 p.m. That is the big one. Spain through to the final after a 2-0 victory over France. That is it, 30 in trade. The Pulse is up next. This is Bloomberg.